Welcome to the Knowledge Circle podcast from Banking Circle. My name is Russell Goldsmith, and in this episode, we'll hear the highlights from our recent webinar that we recorded with Sifted, which was titled The Network Effect, Breaking the Barriers to Financial Inclusion with Interoperability. Our guests were Rogier Schoute of Mollie, Søren of Mogensen of Banking Circle, and Jason Kumpf of Rapyd. The session was hosted by Amy O'Brien, who is a FinTech reporter at Sifted, and Amy started by asking each of our guests to introduce themselves.
Hello, everybody. My name is Rogier. I'm the Chief Product Officer at Mollie. Mollie is one of the leading online payment companies in Europe. We serve over 130,000 payments businesses and historically have been quite focused on SMBs, a quite excluded group in the financial sector.
Yes, hi guys, my name is Søren. I'm contributing to the growth agenda across the Banking Circle Group. Banking Circle Group consists of 5 companies. Banking Circle is at the core of it, the bank. But around that is a rich set of propositions, including Billa delivering B2B BNPL, Ulend delivering merchant lending, B2B delivering cards and business payments, and finally SEPA Express delivering account-to-account payments. We're very excited. I'm very excited to be here today. Thank you.
I'm Jason Kumpf from Rapyd. I head up our global partnerships and ecosystem initiative. So we're working with other groups to help offer Rapyd services through them to their clients. So we started off as an enterprise opportunity for end clients, and we've walked down into the SMB space, offering more and more of those enterprise level features towards SMBs, which we think is a big help towards interoperability and opening up the democracy of the financial service sector.
Brilliant, thank you. So moving on, let's get straight stuck in. I'm first going to ask for a couple of definitions around the terms in the title of this talk so that we're really clear about what area of the ecosystem we're talking about. So Rogier, I was really interested in asking you about what exactly do we mean when we talk about interoperability in payments? I really have a bugbear with that word.
Great question and terrible word indeed. Now, interoperability essentially means that when multiple payment schemes or networks work together and are compatible to create a holistic payments or financial experience. There must be a requirement that a financial or payment transaction is initiated in one network and then has an effect on another network. And to make that simple with an example, it could be, for example, a cross-border payment that we have seen for over a couple of decades, right? That's initiated in a domestic scheme, then has an effect at the end of an international scheme. It could be a payments transaction that has a certain pay-in lag, for example, a card payment, that then get paid out through a different network like a banking scheme. I think the reason why this word has become so big in the past years in the public perception in payments is because there've been many new fintechs coming up with different type of products, fueling a lot of like digital innovation. At the same time, I think we have, as an industry, realized that these schemes and services aren't always compatible with each other. And the result of that, the negative result of that, is that that excludes certain groups from getting access to those services, and that doesn't lead to financial inclusion. So interoperability essentially means connecting those different payment schemes, and I'm glad that different companies, including the ones in this call, are making an effort to make that happen.
Brilliant, thank you. That was super useful. And I guess the other definition I really wanted to establish from the topic was what we mean by financial inclusion in this context, because it can really mean quite a few things. In FinTech, it can mean inclusion of customers with different socioeconomic backgrounds from different countries, or it can mean financial inclusion on the business side. So Jason, in reference to this topic, what are we talking about with financial inclusion? Is it for different businesses, different types of businesses, different types of customers, or is it in fact for both?
Sure. And if I can just add on to what Rogier just mentioned as well, I'm viewing interoperability as also beyond the direct payment schemes, which we're all part of, into other financial aspects. So lending, accounting, anything else that's financial, that's part of the way I view it, right? So there's some times where a group can use the payment scheme, but is it connected to the accounting scheme? Is it connected to a lending program? Is it connected to all these things? That helps include more and more people with that. So I think that rolls into what you just asked me. There are many things in financial inclusion. right? So it is the lending, the accounting, the payments, the ease of use as well. So all those things can mean financial inclusion. And that means anywhere from enterprise businesses where we started, all the way down to SMBs and to really startup growth companies as well. And that includes a lot of people, individuals on the socioeconomical ladder may have different businesses that they're part of, right? So they're probably not part of a Fortune 500 company, but they might be part of a $100,000 a year e-commerce company, right? So in that sense, helping that $100,000 a year e-commerce company is helping more and more people.
Great. I'm glad we've got those two definitions clear. So I guess that I really wanted to start off by asking you, Søren, about what the main barriers businesses face when they want to launch banking services in new markets. Like, obviously, this is a very broad question. So maybe it'd be most interesting to talk about the most difficult areas of banking payments to launch abroad, especially within Europe, and why.
I think I'll point to two or 3 points that keep recurring when we speak to clients about their expansions. The first one is very basic. We speak to clients outside of Europe looking to come and do business in Europe, seeing that the effort of building themselves into the financial infrastructure, getting the required licenses, are just extremely time consuming. It can mean that it can take more than a year to actually have live flows and live operations. And what we in some cases are able to help with is to speed up that process. We are an ecosystem, and one of our companies has its own licenses and is able to onboard companies that don't yet have their own license, and basically take the safeguarding in the company on our side, meaning that a company can go and test the waters and basically initiate their business in a given country while they build their own regulatory and business platform. It's a typical banking as a service proposition that enables the challenge of basically just testing the waters in a given market. I believe that would be a first point. Second, companies in Europe that are looking to expand to other markets very frequently have the question of IBAN discrimination. It's a conversation that is frequently had in forums like this, and it basically means that they would like to expand to another market. Then, do I need a local IBAN, or can I operate with an IBAN account from a different country? The answer is that in most of the cases, you can absolutely operate with an IBAN of a different country. And we, for example, we are one provider that can enable that. But there are some perceptions, something I would call irrational perceptions about, in some cases, the preferences for local IBANs, and that perception barrier can be something for a business to overcome and find different solutions for. So those are two examples of challenges when expanding business into other continents or other countries.
And I guess that within the SME area, I'm really interested in what the main barriers are when a company actually wants to start offering more financial services and embedded payments, etc., to their customer. I'm interested in what the biggest roadblocks for them are in that sort of specific area. So Rogier, I don't know if that's something that you'd be able to answer.
It's a really good question. I think the barriers that SMBs face are multifold. So first of all, I think, and this is kind of a cliche, is that SMBs are underserved. The reason why it's a cliche is that people often talk about it, but it's actually real. What you see is that great products that are being launched in the market, they are often targeted towards larger businesses. And the reason for that is that there's a perception, for example, that SMBs are not profitable, or it's very expensive to onboard them and to serve them relative to the benefit that is being out there. So yeah, that's to a certain extent caused by regulatory burden, but also kind of due to the nature that the industry and shareholders often look at SMBs. And Mollie from day one has kind of taken a different approach. We've tried to use technology in order to basically make things more efficient and make sure that SMBs can, through the scale and technology advancements that we create, can get access to great products. So I think technology really helps there in order to break down regulatory burdens. I think there's also other barriers, and that sometimes has to do with, for example, competitive dynamics and views. The fact that certain ecosystems in payments try to create closed loop ecosystems, right? And make sure that SMBs can not use other services next to the other core services. And therefore, it's so really important that there are companies out there that make sure that SMBs can get access to different types of services that they can use kind of alongside each other. So I think to a certain extent, it's the regulatory piece that kind of limits access. It's technology, it's kind of shareholder perceptions, but it's also policy from certain companies to try to create closed loop ecosystems. Yeah, and again, a company like Mollie and many other companies out there, but we try to change that by making the services available for everyone, but also making sure that companies can integrate other services on top of our services.
And I guess like a follow-on question from that, actually, with the regulatory side of things, is like in terms of sort of sharing the resources. So obviously compliance teams can be hugely expensive and a really massive drain on resources for companies. So through this collaboration, do you ultimately save money for companies?
Yeah, I think at the end, the collaboration on a compliance level is still quite limited, to be honest, if you look industry-wide. So it's definitely something that I believe can be and should be encouraged. I think what probably the bigger challenge is here is to convince regulators that technology can often help to create new kinds of solutions to solving very fair regulatory concerns. And of course, as an industry, you have a joint responsibility in order to do that. So yeah, companies should definitely work together there. And we've seen some really successful examples in the past years. For example, in payments, the onboarding experience of SMB customers has improved vastly over the past 10 years. And it has, for example, become market standard nowadays that companies can start trading without having completed the full onboarding. And that's something that the industry has jointly kind of achieved. But there's many other barriers still to resolve.
Thank you. Super interesting. And I guess, Jason, that sort of leads me on to we kind of slightly covered the answer to this question there, but I'm really interested in terms of like the actual individual end customer from all these B2B2C companies. How is their access to financial services improved by the different payment networks working together?
It definitely gets
regulatory. Sorry.
Yeah, of course. So regulatory is one aspect of it. The payments angle is one aspect. Other financial services, like we mentioned before, are another aspect of it. And I think anything that enables people to save time by having things bundled for them, and probably in that bundling, a reduced overall cost of each service when groups come together. When we partner with other groups, all 5 of us are going to offer one service, and we're all going to have a lower cost because we're getting more clients because we're offering more. That ends up helping the end client tremendously, right? In terms of one, like I said, time savings. They've got one solution that affects their payments, their global payments. So instead of working with just a European player, just a Latin American player, just an APAC player, just a US player, they can use one like network that has all of those players put together, has lending in each of those areas put together, has accounting, which is very different, each of those areas all put together. They're saving time and money with that, right? And so hopefully that gives them more time to grow their business other ways too. So it's a multiplier effect with that. It's just not a one cost line item. It's a multiplier on that. So I think that's always good. I think clients want more and more services bundled together. We hear that a lot because of that time element and because of the cost elements. And APIs definitely make that a big possibility, right? When you have the APIs that groups can use to expand their offering to their clients, it's always a benefit.
Yeah, and I really wanted to press a little bit more on that, because obviously I asked about the cost savings for the companies themselves, through collaboration, but how about for the end consumer? Does like the trend for more and more partnerships between B2B fintechs mean that the products they want end up cheaper because the APIs are saving on resources? And like, I guess part of that, I was also quite interested in the financial inclusion definition of a consumer from like their economic profile. Like, does their inclusion improve if the products ultimately get cheaper from more and more partnerships? It's like huge cycle.
Yeah, I think what Roger was saying before about, regulation. So that's one aspect, and there's also responsibility on the private companies to attain that regulation faster and cheaper. So a whole industry, RegTech, sprouted up maybe 7 years ago, 8 years ago, that didn't exist before. It's not just FinTech, there's RegTech, there's SecureTech, there's all these dash techs in there that all of them come to the market and help manual systems that financial groups had to do 10, 20 years ago, and now they've turned those into pennies a transaction, right? So that's the baseline. And then with that baseline transactions happening at a cheaper rate and faster and more accurate many times, that enables us to all offer the end client discounts as well, which is quite important.
Super interesting. I guess that I want to move back a little bit to regulation, actually, if that's okay. Obviously, as a fintech reporter, it's one of my favorite topics. Søren, I've obviously seen that most of the fintech regulations we talk about in Europe are focused on interactions with the end consumer and their data, and obviously like protecting that. But what are the main regulatory talking points in terms of B2B fintechs, like the ones on this panel?
It's a great question, Amy. And first of all, I think it's good that there's so much protection around the consumer, that we have focused on that. That gives us a framework to work within, and that applies to everyone throughout the value chain. So that's really great. But exactly as you say, there's also regulatory initiatives and frameworks in the business-to-business context. I'll just touch the tip of the iceberg by talking a little bit about PSD2 and 3 and KYCC/KYT, a lot of acronyms there. But if we start with PSD2 and 3, in the PSD2 regulation, we've actually seen a requirement towards banks, for example, Banking Circle, to treat other payment businesses with a lot of protection when it comes to offering them accounts. Just to give you an example, businesses are protected by law from just being debanked with no reason. Consumers don't have quite the same protection, and it sets boundaries for how you just offboard, whether you can just offboard a business. And there are very strict regulation within that for us as a bank to adhere to. So that is one very specific point that we live and breathe. Look into the future, we believe, and nobody knows this, but we believe that PSD3 will enhance this further. We believe that PSD3 will not be a revolution. We believe it will be an evolution of the current PSD2, and we believe that one of the evolutions will be enhancing this exact point of protecting businesses from being debanked. That's the first point, an example I'll make. Secondly, many of us have heard about KYC, which means you need to know your customer very well when you do business with them. What is increasing is KYCC, knowing your customer's customer. And indeed KYT, meaning knowing your actual transaction. Now, reading the newspapers, we could all see that the Trustly case from Sweden gave us an example. Trustly were told that they should, to an increased extent, know their clients better, even though they didn't have a direct relationship with them. That's really an example of how everyone in the financial system are increasingly being told to seek more transparency and deliver a higher degree of certainty and comfort in the financial system. And Banking Circle, we try to address this by having targeted on-sites, aiming to understand our clients better, understand what they're doing. And we highly acknowledge this push from regulators. So PSD2 and 3 and KYCC as examples are elements that are perhaps not as explicitly discussed in the media, but are certainly protective elements securing trust in our financial system.
Following on from that, I'm interested in, when we're talking about interoperability, I'm interested in the number of fintechs and fintech adjacent companies that have been popping up. Like Jason said, like we've got loads of new reg techs. What about the sort of fraud focused startups? Is like, because obviously it's becoming quite a crowded market in a way, but on the other hand, it's such a huge problem, if you will, that where do we reach sort of peak collaboration on all of that? Or is it sort of an endless market that we can just keep on like addressing new parts of this regulatory hurdle?
I believe there is so much potential to be reaped from here. I think there's a lot of great examples of fraud and transactions monitoring startups that are really showing to be very strong cases. One of my favorite examples is Sentinels, the Dutch-based AI system for transactions monitoring. I believe they have fraud as well. That is real time. This has been delivered by a very strong team, and they partnered up with PPRO and others to proliferate their solutions. This is an example of smart people coming out, delivering something that just makes the systems better and that just help the ecosystem. I think my general challenge with this, and why I think there's so much more to do, is that sometimes these companies assume data to be in a good order in companies, and we'll just have to face the facts and the realities. Data is not always in a good order. Data is not always in the cloud. Data is not always in the shape that you would want it to. Sometimes it can be difficult to implement these strong systems into a legacy-heavy bank, for example, because they are just not always in the cloud. They are just not always with very clear and simple architectural setups in their structures. So the challenge in some cases is in fact to take these brilliant systems and make them applicable also in organizations that are incumbents. And that's sometimes what we in Banking Circle think we can help with, because we don't just apply a piece of RegTech, we actually operate the flow for our partners, that whether that is payment companies or banks, and we are able to apply such advanced transactions monitoring that is AI enabled by taking it through our own filters. So I think we will see a matchup of the RegTech initiatives and us actually delivering the flow, which collectively will make the system safer and more resilient to fraud and money laundering.
I would say, from my perspective, the collaboration on financial crime prevention in the industry is still fairly limited. Unfortunately, there's definitely some good initiatives, including Sentinels, the company that you just mentioned, and other companies trying to play a role there. But what you see is also that many companies still very much regard this as an organization-specific topic that they need to focus just for themselves, which is often already costly and hard enough. And that the, common frameworks, and there are more sanction lists and other mechanisms prescribed by regulators that are sometimes a little bit outdated. So I definitely think there's a lot of space for better and more collaboration by the private sector in financial crime prevention. And I really hope that organizations take their part of the responsibility there.
How are you working to better support gig economy workers? Are there products on the horizon to support them better?
We have some services that gig economy platforms use already. So we've integrated with them and offering multiple services from collect, disperse, card issuing to those groups, lowering those platforms' costs. So lowering those platforms' costs enables those end gig workers to take more home at the end of the day. So that's the main option we're offering. And expanding the reach too, right? So you can be a gig worker in more and more countries as well, right? So I think like Uber started in the US, a bunch of things starts in the Western world and go out, although now more and more starting out of APAC and Asia too. So we're just helping expand that into other groups such as Latin America and other places.
What I can add on Mollie's perspective is that we're very, very focused on allowing any entrepreneur to start up basically their business with online payments within a number of hours. And that also means that, for example, accepting payments on the go and facilitating other use cases that are really important to different groups, including gig workers. are of big focus. And one area we are really excited about, for example, is the evolution of point of sale systems, which used to be always hardware based. And we see that now more moving to a software based basically system, which essentially could mean that anyone with a mobile phone can start accepting payments with the latest technologies out there in the market. So yeah, that's the way how Mollie is starting that, not only at gig workers, but they're definitely part of the target group of people who would like to enable.
Thank you, guys. And there's another question that I'm just going to go straight in with, another sort of industry specific one on the question of blockchain. So this is much more in the weeds on the payment side of things. Are blockchain solutions like stable coins or fiat tokens running on the Bitcoin Lightning Network a threat or opportunity to payments products like yours, given they offer virtually no transaction cost, immediate settlement, interoperability, and borderless reach?
I think what we're talking about here is innovation in the financial industry. We should all welcome that. That innovation is, I think it's still in its early days. I think we've seen it advance significantly in the past couple of years, and we're seeing more and more relevant use cases. I remember 5 years ago, people called it a problem, a solution looking for a problem. I think we are seeing real use cases now. I think we are seeing how this wonderful piece of innovation is proliferating. But with that said, it is my strong belief that nations will hold on to the fiat way of paying. They will hold on to their currencies as one of their mechanisms to manage nations. And I don't see anytime soon this replacing anything. I see it as an augmentation. I see it as a supplement, and a most welcome supplement. And that means that we need a bridge between the two, a bridge that can combine fiat with crypto. And that is, for example, what we, amongst others, are delivering, an ability to convert the two. So I don't think it is a replacement. I think it is a most welcomed addition.
I agree, Søren. And just one thing to add there. In general, retail or online payments, crypto has just not become a major thing there. And people often talk, of course, around the potential benefits of zero cost or low cost. But if you look at reality right now, the cost of actually exchanging crypto to how they call it regular currencies is still very, very high. So cost will need to go down. Of course, you can the cost is actually a problem right now still of crypto instead of a benefit, and that would definitely need to change. But seconding also Søren with his prediction that the regulators and central banks will definitely hold to their own currencies. So I also see it as an addition to what we have today.
And Jason, did you have anything to add from Rapyd's perspective?
Yeah, I think to Søren's point, it's innovation, right? So this is, we got deep into Bitcoin Lightning Network. There's a lot of other solutions out there in the crypto world. So it's interesting. It's like the Cambrian period where there's literally thousands of different options out there. And then as this evolution goes forward, there'll probably be a handful of services that end up being more and more useful. And I'm sure all of us on the call, our companies, our tech teams, are always looking at new innovation and new services, right? Our companies 10 years ago or 20 years ago would have been looked at kind of in a similar vein. And so I think as progress happens, change happens, and at the end, it's a benefit for the end clients, right? To always have us and new technology out there that could serve them better.
Definitely. And I think this brings us nicely to talking a little bit about the future and, what's going to happen in the next few years. So obviously we've been speaking quite a lot about this sort of trend towards bundling and everybody working together rather than the unbundling that we saw a few years ago. Søren, I'm interested in your crystal ball predictions, sort of 5 years time. What do you think the B2B fintech landscape will look like? Do you think it's going to be far fewer players on the market because they will have consolidated maybe through this period in the next couple of years through M&A? Obviously, I'm keeping my eyes peeled for this at the moment. Or do you think the market will be just as busy, but everybody will be working together? So we'll have quite like a complex network of partnerships.
It's a great question. And I think you should keep your eyes peeled. That's probably the short answer. But the more elaborative one is that I believe that the landscape in 5 years will be impacted by what we are going to go through in the coming time. There's no doubt that valuations have changed. Capital is more scarce, and we are seeing that impact the sector. We can see it from interactions with clients, and we can see it in the media. Dozens of well-known fintechs are reducing their FTE base, typically between 10 and 20%. And I believe that will launch 3 key trends. First of all, a focus on what each company does at its core, and just to do that well. So perhaps we'll see less innovation from those companies, but maybe stronger delivery on their core focus. That's the first trend I believe we will see. Second, as a result of that, each fintech will continuously seek to offer a rich and sticky proposition to their clients. And that means that the second trend, in my view, is partnerships. We will see that as each company focuses on its core, delivering that very well, they will come together to deliver very strong solutions through partnerships. Back in COVID, we did an interview of 300 C-suite decision makers in banks. They already back then said that they saw an increasing need for partnerships. And we believe that will proliferate, and that will happen even more across banks, payment companies, marketplaces, and much more. And then thirdly, the final trend, I believe, is going to be that of consolidation, the M&A rebundling that you were referring to, Amy. I believe that in some cases, we will see the partnerships being so obvious and so strong that it will call for combining equities as well. And in other cases, it will be because companies are seeking to pull strength and just become more solvent, more resilient by teaming up. So focus, partnerships, and consolidation are 3 trends I would expect from current circumstances.
I really wanted to ask a sort of follow on, maybe for one of the other 2, but also I love your crystal ball predictions as well, if they vary at all to Søren's. But I'm also really interested, I don't know, just anecdotally, I've seen like, in my pitches inbox this year, so many partnerships in a way that I'm like, is this a cheaper way of doing things than M&A? Like, why are all these partnerships happening right now within this market? And so I don't know if somebody wants to comment on that as well, like this sort of trend, especially this year.
I can jump in on that one. I've been in partnerships for over a decade, and I think before it was looked at as a simple add-on, and a lot of times, oh, let's make a partnership with this group, and you get in-house people. So no, we're going to develop that in-house already, so we don't need to work with them, right? So I think that attitude, as Søren and Rogier said, has shrunken, right? And now it's like, let's focus on our core, let's do that really well, and add-on functions can be done with other groups that focus on a different core. Even if it's very similar, right? Sometimes there's overlap, but that's there. So I think definitely the partnerships angle is a way to enhance your services, sometimes immediately with simple, partnerships, maybe months, a year later with more elaborate integrated partnerships. And the cost is very minimal to start these up usually, right? And the benefits can be massive. So the positive jaws on a partnership are huge, right? The amplification effect is massive. You don't need to do a massive acquisition to do that, where there's a lot of other risks involved. You can have multiple partnerships with multiple groups. You wouldn't go buy 5 groups in the same sector you're looking at, but you can go partner with 5 groups in the same sector, and you can see, how they all work out, and maybe they all offer different variations, different geography coverage, different service provided, where buying all those would be, not feasible, basically. And so it keeps your costs down too for your end client as well. So sometimes can be cheaper than that. So it's a great space, and I think people are just the general environment now is more collaborative, right? Business is competitive, it's a competitive landscape, we're all in, but there's more and more, views of collaboration, even with groups that have an overlap of 50+%, right? You want to add that extra 10% to your business, and you're willing to collaborate with other groups, and everyone's very friendly in the space. So it's great.
Well, really well said by both Søren and Jason. And just the only thing I would like to add there is that the last years have also proven that basically the notion of doing it all yourself, right? Like 5 years ago, everybody tried to create Europe's WeChat ecosystem, or basically the single operating ecosystem, both in payments and also in commerce. It just doesn't work in, particularly in Europe, right? Where there's so much complexity, differences between countries. And I think organizations have learned the hard way that, first of all, building it all yourself is tremendously difficult, right? Having the engineering resource to spin it all up is really, really impossible. And then secondly, it's also not succeeding, right? Like, so I think many companies have learned that doing so many bets at the same time, it really distracts you, as Søren also said, from the core. And I think the financial situation now forces companies and the fintech industry to basically collaborate and really rethink about what everybody is good at. So it's kind of a bit of a reverse trend of 5 years ago, where everybody was talking about creating Europe's WeChat ecosystem. So yeah, I think that's good to see, even though there's still some examples of ecosystems that try to do it all themselves, right? So I'm very curious to see how that will go. Shopify is an example from a commerce perspective that still very much has that closing of the ecosystem as a core part of their strategy.
Definitely. And I think I recently wrote on whether Europe will get a super app soon. And this was a big part of the conversation, was this sort of trend was unbundling versus bundling, and sort of what's worked in Asia hasn't really worked in America and Europe in terms of that. One last question connected to sort of the current economic situation and this increasing partnerships trend. Is it less commitment? Can you just drop a partnership when it isn't working? Is it sort of like a bit of a sandbox, a testing pad for what's going to work with your business as well?
It can be, right? So that's the way we offer it, is there's multiple phases of a partnership. So you can start with something very low risk, easy to set up. We're talking days, right? So the commitment and the overall risk is easy. And then as they grow and as they mature, as they prove out, then you can have a more integrated partnership. So I think that's one of the big benefits, right? Versus building it yourself and spending a ton of resources, and then after 6 months it works or it doesn't work, you're relying on someone else's hard work, and you're leveraging that for your group, right? And offering that. So 100%.
Yeah, I think it definitely allows for sandboxing, and it allows a go-to-market that's a lot faster than if you would build it yourself. I think many companies have the notion of like, eventually we will build this in-house. I think also it really depends on like the economics in the partnership, right? How much is there to share? And then secondly, how well the partner is adjusting to basically the reality of growing volumes and changed circumstances. So there is a notion of a sandbox, but what you also see is that some of those partnerships are simply lasting forever because these partners kind of adjust with each other.
And I don't know, just because I don't work in partnerships, so I'm really curious, like, can you just sort of quit the partnership at any point if it's not working? Like, how does that work?
Depends on how the commercials are written up, right? If there's other commitments, there's co-marketing, other things, maybe it's a little bit longer lasting, but it's a lot easier to unwind than if you purchase a company or if you've developed a bunch of stuff in-house and there's internal commitments to it that may or may not be right. So there's definitely less constraints on that.
Yeah, and I think there's a trend towards flexibility in partnerships too. I think 5 years ago, when partnerships happened, you tended to see more 5-year exclusivity, big volume commitment type of partnerships than you see nowadays. I think many fintechs, they operate from a mindset perspective that you need to be fast and flexible. So of course, there's some mutual commitments in many of the contracts out there. But yeah, the trend is really going towards like, hey, the best party will prove itself. And there's fairly little mutual commitments in those partnerships, and it's more value-based than contract-based. At least that's what I'm seeing in modern fintechs nowadays. I don't know if Jason and Søren share my view.
100%.
I agree. I think there's some of the strongest partnerships we've seen are the commercial partnerships, where we team up with a partner on delivering, for example, our solutions to their merchant base. Ulend, Banking Circle Group company, has teamed up with a multitude of partners, including Shopify and eBay, and through those relationships delivered solutions to the underpinning SMEs and merchants. And as those, exactly as you say, Jason, as those then ramp up commercially and prove themselves, they become very, very attractive and very sticky in nature. And that's the most healthy way to structure them, to basically see them succeed and see them become attractive to hold on to.
Super interesting. Thanks, guys. I feel like I'm learning so much about the nature of partnerships here. Hopefully it's as interesting for the audience as it is me. But I'm now super interested in asking, more about sort of the landscape and what these increased partnerships mean. Like the flip side of this sort of trend towards bundling is, like, some would argue that with this increased partnerships, are we going to see less competition? And does it mean that one single company can't do it all and have enough market share that it becomes like the multi-billion-dollar company that the European fintech ecosystem needs to, grow and get on a par with the US? So big existential question, but how can we strike the right balance between collaboration and competition? Søren, do you want to start?
I think in the old days of strategy, people were taught to watch out for channel conflict. You target a segment and you make sure you don't conflict with that in any kind of way. If there's anything I've learned from banking and fintech over the past 10 years, it's that just cannot last, and that is not acknowledged by our industry, because we see fintechs target all sorts of channels in all sorts of ways. Just take how strong companies deliver a feature to a client and let themselves partner up with someone who has a strong platform, whether it is Betterment and Wealthfront delivering wealth management solutions, but also acknowledging the partnerships of being rebundled onto another interface. We see companies like N26 and Revolut, but also in the Nordics, Lunar, team up with different fintechs and different features, take their solutions onto their interface, which means that you will have a consumer-friendly platform where all these other fintechs are shown, and that will be perhaps a step towards a rebundled platform. But these features are in fact also solutions on their own, which the consumer can reach directly by going to these propositions. And in that way, the anarchy of that just means that the best solution and the best connection wins, and the consumer wins, because the consumer has the freedom of choice whether to have these solutions packaged in a nice interface, or whether to go directly to the features that they prefer. And I believe that democratization and that setup allows for a continued high degree of competition.
And Roger, what's your take?
So no, the balance between competition and collaboration. Well, I believe what you see, interestingly, is that competition has become more transparent in a way, right? Like 5 years ago, as Søren said, maybe strategy was kind of perceived differently. People were more secretive around a strategy and what's going on. I think you nowadays see a trend where companies essentially publish their product roadmaps on the internet, right? And things are pretty public out there. We know what our competitors are doing. Our competitors know what we are doing. And people are less afraid of that. And I think that really has to do with the fact that we all realize it's a lot about execution capabilities, and of course also more subtle competitive advantages that companies like Mollie have that are very hard to duplicate. So I think that balance, and then adding partnerships on top of that, that in the result makes partnerships easier, right? Because the thing is kind of more transparent. Companies will still be very they call it clear about which areas they're willing to partner on and which not. But I think striking the balance, I think that has kind of shifted. I think it has become more open, and the competition is again, it's more about execution than about strategy in that sense.
Thank you. Super interesting. And Jason, last, your take on this existential question.
Yeah, sure. I think I'd like to start with the numbers, right? So the last McKinsey study I saw, payments globally was 1.9 trillion. So let's say 2 trillion globally. So that allows for a lot of multi-billion-dollar companies out there. And because you're partnering together, there's a multiplier effect, right? That $1 is split up amongst multiple different groups. Each of them touching it and funneling it through those groups. So it even makes it even more than that. So there's a lot of opportunity opportunities for different companies. And I think, instead of repeating what Rogier and Søren have said, which is very accurate, I said we'd even gone to the step of enabling groups to compete directly with us by building apps on top of the system. So I think a lot of groups are doing that as well, saying that never would have happened before. I think there's a model that was pioneered maybe a decade or two ago, allowing groups to sit on top of your application, build applications that might compete directly with something that you're offering, but the end client now has choices, right? And if you're the underlying FinTech offering the regulation we spoke about and the network effect, then those smaller groups can now take that and add value to their niche segments as well, right? Instead of you trying to go after all these niche segments. So I think that's great. And I think when there's a balance of collaboration and competition, the word was cooperation, that's real now, right? I don't think 3 years ago I never heard of cooperation, right? So it's a factor now that's in the market. It's in the mindset of people, right? And I think when it's the mindset, then it starts penetrating into the market, and everyone benefits from that, right? That's how innovation's driven.
Okay, we've got one last question, and it's another industry specific one, which is quite fun. So I'll ask that, and then maybe we can wrap up. Are you seeing more movement in the insurance fintech space in terms of collaboration?
Yeah, this is another one of the hyphenated dash tech. So insurtech is growing now. You're seeing more and more insurtech companies out there and offering different advantages to businesses, right? From easy ways to insure existing cargo around the world, to ensure payments get delivered, payments get refunded or taken, fulfilled. So it's very interesting what's out there in insurance tech, right? So I think that's another example of RegTech, insurtech, lendtech, fintech, right? It's interesting what's going to be the next hyphenated tech that's out there, right?
Thanks, Jason. Thanks for taking that. Okay, I think I'm going to wrap this up because we've covered so much. It's been really,
Amy,
really
there was another question I think that we didn't cover. Is why don't neobanks do more underwriting and lending? First of all, lending requires deep capabilities of data science, and right, many neobanks are focused on actually getting customers first, and then basically further monetizing that. Secondly, it also has regulatory, requirements and capabilities in the organization. But Søren, maybe your view?
Well, thanks a lot, Roger. I think they will. In some cases, they will originate this themselves. In other cases, they will partner. The ULend business that sits in the Banking Circle group enables both payment companies as well as neobanks to offer lending to merchants. So I think, Roger, you're making a great point that neobanks are maturing, right? They are building their commercial platform, and as they build critical mass, they will be adding on additional products and solutions. Undoubtedly, lending will be a part of it to an increased extent, and we'll see it happen. I think it's a great question, and I think the answer is that it'll come more and more, no doubt.
Well, that's it for this episode of the Knowledge Circle podcast. Thanks once again to our guests Rogier, Søren and Jason, and to Amy for hosting. If you've enjoyed the conversation, please do follow, like and share on your podcast platform of choice. You can find out more at bankingcircle.com. Hope you can join us on the next episode, but until then, thanks for listening and goodbye.